Welcome. Welcome to this fourth session of the ICISA Trade Credit Insurance Week. And with more than 3,100 registrations and 1,000 unique registrants, this first TCI week is becoming quite a success, and we're happy and we're grateful to you. Just a word as a start, all panels are recorded, and they are going to put on a private YouTube address, and the people who have registered for these events will receive a link to this channel Friday afternoon late. Now that's for the housekeeping. Now it's my pleasure to introduce this next panel to you, entitled Trends and Evolution in TCI. And this goes back to a dinner I had some 10 years ago in Sydney, Australia. So I was confronted loudly by this broker who proclaimed for the entire table to hear that trade credit insurance folks are a lazy, sleepy, and dull bunch. I must add that the gentleman in question had a fair amount of what I'll euphemistically call tea. Now, if I look at the table here today, the participants are neither dull, nor lazy, nor sleepy. Leading you through the trends and the unmistakable evolution of our industry is Stuart Lawson. Stuart is the global leader of Aon Credit Solutions and has an unrivaled overview of the market. So Stuart, take it away.
Thank you, Richard, and what an introduction. Obviously, as Richard said, my day job is leading Aon's credit solutions business, but it is really a privilege to be able to moderate this panel of experts, and I'm really confident we'll have a diversity of thought and informed insight to the discussions today. So let me quickly just introduce the panelists, and then we'll kind of get going. First and foremost, we have Harpreet Mann, President of the MGA Aminta, Trade Credit and Political Risk. We also have Paul Wolney, CEO Green Stars BNP. Mike Holly, so many titles, Mike. I'll try and fit them all in. We have Charles Taylor Adjusting and Schumann. And last but not least, we have Artus Carlsons from the Bern Union. So maybe a little bit of a backdrop before we start the kind of questions. When we hosted the Aon event last year, we had a headline speaker, which was the former president of the European Commission, Jose Manuel Barroso. And he cleverly managed to weave in a lyric from a U2 song. And his kind of outlook for 2022 was, let uncertainty be your guiding light. And I think that's certainly been the case as we kind of look back over this year and look forward into 23. So on that note, let me kind of get into the questions. So Harpreet, maybe I can start with you first. Whilst we have seen some departures of insurers and carriers from our marketplace, notably Zurich, and in some regions QBE, it's really exciting to see new carriers, new capital coming into our market, and obviously names such as Carton Trade and of course Aminta, your shop. Maybe you can share a little bit of background, what you see to be the opportunity and your growth strategy, certainly from a kind of US perspective. Over to you.
Yep, sure. Well, there's a famous quote by Alexander Graham Bell that says, when one door closes, another opens. And that's certainly the case for many of us in the US market with the news that occurred last year. That created a void. And it wasn't just a void in capacity, but also what these teams brought to the non-cancelable trade credit market, which is flexibility, products that are fit for purpose. And that's why you saw various stakeholders see an opportunity in the market. And, we are both Carton Trade and Aminta are supported by SCOR, and that should not come as a surprise, given that SCOR has been a reinsurer in this market for a very long time. And similar to other reinsurers, they have a vested interest in seeing this industry thrive. And there was certainly an opportunity to support the direct insurance market, and to date that has been welcomed. And you also saw with Aminta and today we are 10 people at Aminta, including claims, that they also saw an opportunity here to support a team that is established already. And I think both Aminta and SCOR demonstrate that commitment to this industry with what we've accomplished in the last year. Our strategy for growth is very simple. It's three-pronged. I mean, right now, obviously, we're working on the platform and developing that out for probably the balance of this year. But number one, just as before, it's customer service. It's making sure we're consistent. It's making sure that we're responsive. And key to that is, from my view as a leader, is that you have to have employee engagement. And the more engaged your employees are, the better your customer service is. The second prong to our strategy is the quality of policyholders. We learned through COVID that those policyholders who have a very long-term view to their business, they tend to find ways to resolve because they have an interest in seeing their customers survive through an event like COVID. And the third piece to our strategy is underwriting credit lens and really looking at credit fundamentals, particularly in this economic environment. I think there's a lot of underwriters that haven't seen a high interest environment within which they've underwritten previously. So it's going to be interesting. So those are the three keys to our strategy.
Excellent. Thanks, Harpreet. And you picked on many of the points I'm sure we'll kind of come back and touch on as we kind of go through the hour. But you mentioned a really good one I'd just like to kind of highlight was around that ability of picking the right clients. It's not just about underwriting risk, is it? It's also about making sure you build partnerships with the right kind of clients which are going to be there for the long term. I would like to maybe pick up on one point because you mentioned SCORE and Aminta is effectively an MGA. Do you I mean, we touched on this before, but do you feel the kind of MGA will continue to be a growing kind of presence within our trade credit market? We've obviously seen a number this year already.
I do. I think the prevalence of the increase in MGAs mirrors a larger insurance market. So in the U.S., the premiums generated by MGAs has doubled in the last 10 years. Last year, 2021, the U.S. market, the MGA premium will be around $70 billion. So it's pretty significant. And therefore, the trend for credit insurance to also see an increase in MGAs would be just a reflection of that. I think the second piece is this line of business has been profitable. And if you look at ASISA's chart with the trade credit premium and the loss ratios, you'll see last year was at 20%. So the numbers plus the increase in just MGAs in general across the market, I think demonstrates that we should expect to see this model. And there's two other points I want to make. One is which the MGA model is pure to underwriting. I spend 98% of my day on trade credit. And I think that's an allure of why underwriting teams do want to be at an MGA. I think the other significant trend I've seen is that historically MGAs have been very niche. So if you look at other lines in particular, you see that. What's interesting is to see an entire team, just as if they were at the insurance company, but on the MGA platform. So at Aminta, for example, we have Surety on the MGA platform as well. And they're just like any other team at any carrier, but on the MGA platform.
Yeah, really, really good point. Really good point. Paul, may I come to you next, if that's possible? I think you're in a kind of a unique position, have a unique kind of viewpoint on our industry. And just some background, Green Stars BNP was, I believe, created and established in 2009 to focus on kind of facilitating credit solutions for the banking sector. Be really interested to get your views of how you've seen that kind of relationship with the trade credit market, reinsurers, clients evolve over that period of time, and any kind of key learnings and observations.
Yeah, yeah, that's interesting question. Maybe when I thought about your question, I was looking even a little bit further back, and when I entered the credit and surety market, I read books about it, what's all about credit insurance. And on the last page of one of those books, I read political risk is not insurable. Financial guarantees, it's not insurable. And it's not so long ago. I think we have to be aware of that. And when we are talking to each other, that's where we're starting from. And so this was around about maybe 30 years ago. So we made a way, but compared to what is the whole turnover, the standard market, we're pretty exotic. And we have to be aware of that. And I think going forward, this will continue like that. Coming back to your question, how the business has evolved since inception of Green Stars. And I have to say, quite, what's the right word? Quite dramatically, with a lot of momentum and a lot of speed. When Green Stars was created, there was already an established market where insurers looked into insuring commodity-related transactions. So these were commodity traders or the production of commodities and types of pre-financing. Why this? Because they knew it already from the bond market. They had put out bonds in favor of the banks. Sometimes they saw that the bonds made losses while the bank transactions still performed very well. So they said, why not aligning with a bank, supporting a bank? So this was already a plain vanilla business when Green Stars was created, and this was our starting point. And then, of course, we needed quite some time to convince the bank that the product as such and the value proposition is attractive, which took a bit of a time. And then I think we got quite some momentum, which is very interesting. The next step was to expand the whole business to asset-based transactions, which I think for a lot of you are today plain vanilla transactions like project finance. Of course, you have something tangible, you know, again, from the bond market. For credit insurer, you have maturities which are just terrible. They're extremely long. And same with other asset-based transactions like shipping or real estate, which was, again, another odd word in the traditional credit insurance market, where it discovered that banks can do it in a very attractive way. Why shouldn't we accompany for it? Paying attention, of course, that you're not exposed to systemic risk. And the last one, aviation, which was quite an interesting market in the COVID area, and where we are doing by far better than I expected, to be honest, during the COVID crisis and also after the outbreak of the war in Ukraine. And then was quite interesting, financial guarantees I mentioned. Are we here? What I'm talking about, are we already in financial guarantees? I put a question mark behind it. Maybe we are. The next logic question was, why do you need always transactions with more difficult obligors and structure around it? Why not going for better risks? And so it moved on to plain lending, where you don't have collateral behind it. And part of the market said, well, this I will not touch. Others said, yeah, you do it only with more attractive clients. So you would expect better loss ratios and better performance and revolving credit facilities. We have made quite good experience during the COVID crisis, because there were also some concerns about, can we really do this type of transaction? And then it moved on to another word where we have to pay attention about how we express ourselves, giving credit lines for hedging purposes, derivatives, another odd word for the credit insurers. And most of you might, maybe not today, but 5 years ago, might have been scared to death by the word. But if you look at the beginning, you always have a price risk in the transaction. You always have an interest rate risk in the transaction. You always have for FX risk in a transaction. So why not supporting somebody who is hedging himself and needs a credit line for that? And why not supporting these credit lines and opening up for the credit market? So this was the next step in the development. It then went further on. And we currently see in line with the rest of the market some interest from banks who start more and more discover insurance. Why not going closer to capital market products like NAV, net asset value transactions, CLO warehouse? Again, a lot of words where I even didn't know the abbreviation some times ago. I think we will come back to this a little bit later on. So you have to make up your mind, how can you be smart enough to accompany these transactions, and how can you be with them. So in a nutshell, it has been, I think, a lot of movement over the last 12 years. And I was thinking, is this dangerous? It's always a question of perception. But if you look about industry, if you're insuring a car, is it the same thing, a car which you had been insuring 30 years ago, or electric car today? I think for the specialist, you don't need to be a mechanic to insure it. You have to have a good understanding. And I think we do the same in credit.
Excellent. Thanks, Paul. And it sounds like quite a journey as well. I'm sure it's had its challenges and fun along the way. Do you think, but I think it's been, I think just listening to you speak, it's been a resounding success with the right outcomes. Do you think that there'll be similar financial institutions who kind of look at this model and take this kind of same pathway in terms of the kind of Green Stars model and structure?
I'd like to know myself. And to be honest, I'm quite curious, so I use every conference to find out, is it still true when I say Green Stars is unique as a model in the world? And sometimes I hear, no, there are two others. And then I check with the people. And I'm aware of a handful of larger banks who have been studying the model, who have followed up the idea. And I think there will be other market participants in the market. But the feedback which I received from banks as well, from other banks, is that they ask, actually the idea is pretty simple, plain vanilla, and maybe too simple to even get to the idea. However, when you get into detail, then it becomes quite challenging. And I see from the discussions which I see in the market, that's where others are struggling, and where I have the luck that I joined a company, or that I'm responsible for a company who has some track record, and when it was created, built on the track record of a bank who had a lot of sophistication. And nevertheless, it took years to prepare the creation of Green Stars. Let's be realistic on that. And meanwhile, we have quite some experience, so we know how to run the business. We know how to adjust ourselves to the business. And one point which I forgot just in your first question, also from the needs of the bank, I said political risk is not insurable. It started all with country risk, which a couple of years or decades before was uninsurable, then went further on to credit risk, but not whole turnover credit risk, more single credit risk, more comparable to guarantee business, to bond business. And today, banks are talking about capital management. So what insurers are talking with reinsurers about. So also there you had a lot of moving. And when you create a captive or a specialized company in this area, you have to bear all this in mind. And this is apparently not that easy. But I'm pretty sure that we won't be alone in the future, which is good for the market.
Excellent. Thank you, Paul, for that amazing insight. And I'll let you know if there's anyone who wants to comment on that in the audience in the questions regarding the uniqueness of Green Stars. Mike,
maybe somebody who already did it.
Mike, let me come to you now. And obviously, maybe with your kind of claims vantage point first. I always think that we have, from an Aon perspective, and I look at from an industry perspective, we have an amazing track record in paying claims, both on structured credit side, as well as obviously the multi-debtor trade credit insurance side as well. But sometimes it's not without its kind of tension and friction points. And I'm just wondering what your kind of initial view is. How do we make the kind of client's claims experience better? We get the right outcome, but can we make the journey a little bit smoother for them?
Yeah. So I started my career in claims in the 1980s. I was working at ECGD at the time. And then in the last few years, I've come back to some claims work. I think the first thing to say is I think we're much better now than we were in the 1980s. I mean, we were a fairly miserable bunch there, I would say, at the time. I'll ask Susan Ross. And I think it is much better. So I have been really impressed. I mean, the claim is really the product, isn't it, at the end of the day? It's the claim performance is what people are buying. And working with a lot of different underwriters, I've been really impressed with how commercial they are at a claim stage and how hard they work to be fair and to give the customer a good experience. And also I've been very impressed by the quality of the people, because the claims people don't tend to push themselves forward onto the conferences, and you may not always hear them, but they're a really smart bunch of people. So overall, I'm very pleased with the way it's working at the moment. In terms of friction in the process and can it work better? Well, of course, it can always work better. So a couple of observations about how I think we could make it even better than it is at the moment. So the first one is I would say to be careful in bringing the underwriter too much into the claims process. So when I look at other lines of business, there's really a very big segregation between the underwriting and the claims. And in credit and political risk, I see a slightly greater tendency to bring underwriters into the story. And I think the reason for that is that the claims process is quite technical. And a lot of the claims adjusters are not particularly financially literate. I mean, if a claims adjuster comes from a legal background, for example, you wouldn't expect them to be financially literate. So then what happens is they bring the underwriter in to ask an opinion. And that may not always be ideal. I mean, if I think about my personal experience of what it's like when you're an underwriter and you have a claim, if it's a big claim, I mean, it can make you feel physically sick, you know, and the feeling of physical sickness might last for weeks on a single claim, and you might, you know, the first thing that you open your eyes in the morning is your stomach sinks and you think, oh my God. So when you feel like that as an underwriter, which is entirely natural, we're all the same, you're not really in the best frame of mind to be invited to come into a claims process. So I think that's one thing, is that let's try to keep it objective and don't put the underwriters in too much of a difficult position by bringing them too close to a claim. The second observation I would have is, in the last couple of years, I've seen a number of claims where the insured has really been disappointed when they found out how the policy would work in practice. So I particularly have in mind, like with these discretionary credit limit claims under an excessive loss policy. And then you actually go into it and the insured is disappointed with the way it's working, and the underwriter is probably disappointed about what happened as well. And I would like to think that perhaps we need to have a bit more training, or we do it, but we need to maintain the training for underwriters and brokers to make sure that what we're selling when it's a discretionary credit limit, for example, is really correctly sold, and we're not promising that the policy's going to do something it can't do. Because when you're in a claim situation, you have this situation. I mean, you really want to help the insured, and you want them to be feeling pleased about the product. But if there was never an understanding of how it worked in the first place, that's a challenge. And that's the last friction point I wanted to mention, is that we have a really great community of lawyers in the market who help us with claims, and they're a superb part of the ecosystem. They have incredible expertise, and we need them and welcome them. However, it's about judging the right time to bring a legal advisor in during the claims process, because if you do it too early, then you can increase the friction in the process, and perhaps that's not necessary. So I guess one alternative, if you feel that you need an outside party in there, have a think about a loss adjuster firm. before going straight to the legal thing, because it just doesn't raise the tensions on both sides quite so much that way if you can leave the legal part as late as possible.
Excellent. Thank you, Mike. Some great learnings there. I mean, I feel sometimes that nauseous and I'm the broker, so I can only imagine what it must feel like when you're sitting there from the underwriting perspective. And I do love your line. I've just made a quick note that clarity point, that clarity to instill confidence in the product, and I think that's something that's really, really important. Arthur, so I'm going to come to you, and sorry it's taken so long, but I think again, I'd like to kind of carry on that kind of theme, but maybe talk around more some of the trends in the market. Obviously, we expected, when we look at the beginning of the pandemic, to see a lot more claims coming into the market, and you look at the loss ratio, certainly on the trade credit side of our industry, and say that it still is a benign market, but with lots of volatility looking forward. How do you see some of those trends kind of playing out, not just in terms of insolvencies and claims, but also maybe appetite and capacity?
Yeah, thanks, Stuart. It's an excellent question. Even though I have to admit that looking into future trends, especially nowadays for claims, it's a very uncertain business, even on a relatively short time scale. By the time the trend emerges, it is kind of usually a wave we already are riding. And this particular unpredictability has especially kicked in the last 2 years. Obviously, when looking back, government support was a key for insolvencies or lack of them, for that matter, and was also a key for the export credit insurance industry. So swiftly expanded government mandates for ECAs, backstop reinsurance for private insurers. It sort of all resulted in a situation where we saw only a minor dip in business volumes in mid-2020. And ECAs, for that matter, bounced back in the matter of months, if, let's say, compared to the previous global financial crisis. So government support, it reached out to a massive injection into liquidity, insolvency measures for businesses. So it's no surprise that in 2021, the Berninian saw a historically all-time low in reported claims paid since we actually started to collect the data from our members. The drop was by almost 20% and reported by both public players, so ECAs, and private insurers. So when we surveyed our members by the end of last year, the answers like, well, we expected and calculated claims to be much more higher than it turned out. It was the most frequent, like a standard answer. So yeah, the expectations actually, they were very bleak. When we surveyed our members just straight after the start of the pandemic and right in the first year of the pandemic in mid-2021, after the lockdown was started in many countries. So in each of these occasions, our members expected claims to skyrocket in the next 6 to 12 months. Thankfully, none of these sort of expectations or predictions turn out to be true, well, because of the reasons that were already mentioned. One trend which is noticeable looking now, after the first six months of 2022, which is like the reporting period our members are submitting the data, is that the expectations for the worst has noticeably decreased. And that is despite the fact that there's a war in Ukraine, there are supply chain challenges, inflation, energy prices are skyrocketing. I mean, you name it. Nevertheless, our industry has become much more cautious when it comes to expecting claims. And considering this kind of uncertainty, we have introduced and developed so-called business confidence index, which is sort of a quarterly snapshot of our members' current and imminent business situation, what's their overall perception on risk appetite, demands, claims, and for the next 6 to 12 months. So this index, together with reported data, which is sort of a historical snapshot of our members' performance, I think gives relatively good overview on what to expect. And in terms of claims, we are in somewhat of a atypical situation. both public and private members are expected claims to stay relatively low. There is no huge concern regarding potential increase. So last 6 months has been a big game changer. The only concern for majority of our industry players has been mentioned, well, what is happening now in the CIS countries, primarily Ukraine, of course, but to mention Armenia and Azerbaijan. Also in Central Asia, there are tensions between some neighboring countries and potential risks of what spillover effects it may cause. But otherwise, there's very optimistic view on what to expect for claims-wise. We see it from the reported data for the first half of this year, and there's also sort of outlook crystal ball view from our members for the next 6 months. So in overall, I would say the confidence is there.
Also, thank you. Great to have that kind of holistic kind of view of some of the trends and patterns that we're seeing. I mean, I would caution that I do think there's a level of uncertainty and unpredictability in our market that you mentioned at the beginning that makes sometimes some of the, I guess, that optimism may be challenged as we kind of move forward into the end of this year and next year. But we may come back on claims, but I wanted to kind of maybe pivot a little bit towards growth. And we talk about trends and evolution. And I've been in the industry for over 25 years. And one of the areas that has always been is how do we look to increase the size of the market? How do we bring new entrants into our marketplace? And maybe, Harpreet, if I can come to you on this question, because obviously you're looking at this from a kind of a growth position within Aminta. How do you think that what do you think is the kind of key to success in growing the size of the market, in particular in the US? Because I know from my perspective, I've always thought that it's a disproportionate small level of penetration that we have in such a large economy.
Yeah, no, I think there is an opportunity in the US market, and we always ask, well, why isn't it growing faster, or why hasn't there been greater penetration? I think there's many reasons, and maybe we need to treat the US market slightly different than other markets. One of my observations is that there's some brokerage houses out there that don't have trade credit teams or robust enough trade credit teams. So I think we need more brokers. And I know, for example, Aon has invested in a number of new folks this past year, and I think that's great for the industry. That's exactly what we need. But because we don't have that at some of these other brokerage houses, we're missing out the opportunity to sell this product, particularly in the middle market base. So I think that's one thing. I think we are not marketing it and maybe enough in the right way. We can talk about what the product does, right? We can talk about what it covers, but we don't talk enough about claims. And I think that's the moment of truth. Just like Mike said, and Arthur said, that's the moment of truth for clients. And if they know how this product behaved or reacted during COVID, that's important information. And we should, as an industry, be willing to share that information in a scenario. And I think that's the biggest selling point. We can also ask policyholders why they're not purchasing the product. Is there a perception that perhaps the product is too cumbersome for them? And by that I mean that we underwrite every single obligor. Is that just an approach that they feel it takes too much of their time to get this product? And then it's interesting when you look at other lines of business like transactional liability, they go to the law firms. So the law firms are aware of the product, and they then advise their clients to get the insurance. And I think we as an industry should be doing that with law firms and also as banks. We often go to banks as clients, but there's no reason why we can't say to a banks, as you're lending to your clients, you should really think about this product, that they should be getting it, because ultimately you're going to be paid from the receivables. And if you're going to remove that risk with this product. And I think those are the kinds of things we need to be thinking about in the US market and focusing on.
Yeah, Harpreet, some really good points. And I think you touched on education, marketing, distribution channels. But again, just to reciprocate, Aon are also pleased with the kind of flow and the relationship with Aminta already. And there's our shameful plug out the way already.
Yes.
Maybe I'm not sure whether anyone wants to comment. Artis, did you want to kind of comment on that point as well about growing our marketplace?
Yeah, just very short one. But I'm afraid that I may sound too over optimistic about everything I say today in terms of claims and also now. But I think it's important to stress it out. On top of what Harp just mentioned, from our industry's perspective, on a very high aggregate level, what we see that there's already an increase of market penetration of our industry's products on a very broad sense. One very illustrative example is, we tend to compare how the increase of proportion of actual trade covered by our industry's members stand in terms of global merchandise trade volumes. And what we have noticed is that this portion of global merchandise trade that's being covered by our industry's players is actually slowly but gradually is increasing. So this is one indicator. So actually there are 2 points which I would say that are determining. So from the data that we are seeing that there's already growth, and the other factor which determines this increase is innovation or technology. So as for the first point, so from our members' data, there's a noticeable pattern of change towards other markets. As I said, it is very small, but the change is outside Europe, which is, as everyone knows, the stronghold of trade credit and export credit insurance. US is a good example. I mean, North America in general, if you look back 10 years ago, then that region, let's say, took around 8% of all the reported outstanding commitments, as well as trade covered. Then now, 10 years later, we see that gradually this change portion has increased to around 16%. Well, some may say it's not a lot, but still, the change is visible also to other regions. Sub-Saharan Africa is worth mentioning. We see from the discussions from our members that they see more and more interest in the region. For example, well, that will be about MLT projects more, but blended finance solutions as a tool to crowd in public and private lenders to insure projects which are of higher risk markets and maybe 5 to 10 years ago were of no interest, not only to private players, but as well as public ones. So this is one. The second factor, as I said, is innovation, utilization of new technology. Again, it's almost banality to say that we live in information age and that the technology is driving it. Some of the technological solutions that we considered to be the future a couple of years ago is already quite mature. Application of blockchain automation for larger of our members. We see the machine learning applications or algorithms have been applied to underwrite, to foster the process of underwriting and become much more accessible to not only to their traditional clients, but also to reach out to SMEs. So our industry is growing. A technology revolution is happening also within our industry. And this is what, for those who will be on the right side of the curve of this growth within our industry, those will be the ones who will sort of delve into new markets. Just one point to say that a while ago there was this stereotype about the public players and about the digital developments. And 2 months ago we had a discussion on digital developments, where our industry stands. And I have to say, even some of the private members of ours were surprised by the innovation for automation, for example, that has been introduced by some of the ECAs. So sometimes they stand even a couple of steps further compared to the private players. So all of this summed together is what helps our industry to grow already.
Excellent. Also, thank you. And I don't think you should ever apologize for being an optimist, by the way. So You've touched on at the end, you touched on technology transformation. I think that was the phrase you used, and also this kind of digital journey that a number of the carriers are on. Maybe Mike, with your other hat on, I mean, where do you think the kind of major impact we will have? I think Arthur's mentioned artificial intelligence, which is obviously linked to underwriting capability, but also that customer experience element as well, I'm sure is important.
Yeah, so I think one of the benefits of technology is that it changes the structure of the industry. So, many, many years ago, you had like everything in the hands of the three big insurers. And the reason there were so few of them was because the entrance barrier was so high. The entrance barrier was technology. Whereas now, we've got a more diverse suite of underwriters participating in the market. And to have a fully operating kind of market system, you need to have in the ecosystem, you need to have the really big, long-term players, but you need to have the fresh blood coming in to renew the system. And I think that one of the reasons why penetration has been a bit low in our class is because we haven't had, that nice revolving and competitive market with a larger number of diverse suppliers acting in the market. Whereas now it's coming more, and I think that will help to grow the market. So where the technology comes in is that the technology is now at the state where it's actually not such a large entrance barrier. There are a number of providers to the market so that when a new entrant starts in this space, they can almost get the technology and plug it in and get started and enter the market. I think for me, that's the most profound impact of the technology is just like a democratization, which makes it easier for new teams to come in and participate and therefore grow the market. Of course, some of those teams, I mean, we have some players in the market like Akodo, for example, where it's a little bit more where the technology is really driving the thing. And that's also welcome. And you see that in other lines of insurance where you have like insure tech companies that are growing the market by using their technology. So we're getting some of that into our space as well. And that's also really, really welcome, I would say.
Yeah, no, it's a good point. And I think that bringing that I call it's probably the wrong phrase, but passive capital that can come in, that can use some of that technology, the algorithms, the machine learning. Again, maybe back to the kind of comment we talked with Harpreet at the beginning about growing our market and bringing new capital in. I think that gives huge amounts of opportunities.
Yeah.
Paul, if I can come to you, because I'm really conscious that we should also focus on financial institutions. Is such a big part of our industry now. In both the trade credit and the structured trade credit side. How do you see, when you think about how the product is being used across different asset classes, how do you see that changing? I remember I was at the Aon reinsurance event in Ireland, and there was a lot of discussion around SRT, significant risk transfer solutions. Intellectual property financing is an area that I know has been discussed extensively, certainly within Aon. What other assets do you see this kind of growth into other asset classes continuing, or do you think it will be kind of focusing on what insurers know best?
Well, it's a bit of a difficult question. I don't know the future, but when I'm looking back in the past, and you had been asking the question how we developed, what changes we have seen, I expect that these changes will be going on. The question for me is how can we deal with that? And for us, it's true, but for most of the insurers, we're pretty small. For example, in our example, 14 people against a bank with 140,000 people, you can't be smarter than them. So the added value which you can bring into it is a different one. And that's what you have to think about. And you have to understand what is the driver behind. Do you really understand what your counterpart is? And you don't have to understand every detail, but you have to be able to challenge it. And you should understand. And maybe they're coming back to one point Mike said just before it, where I don't 100% agree. We said that underwriters shouldn't be involved in the claims process. Claims are an opportunity for learning for the underwriter. So I wouldn't take them totally out of the process. So again, coming back to your question, I think we have to see what is coming from the market. How can we be aligned? And there's one question, especially with banks, where, of course, they are insured, but I think it makes sense to look at them also as if they were insurers. And as an insurer, you act a little bit like a reinsurer. So you're looking on whom are you dealing with? What are they doing? How are they treating you? And how are they treating with their clients? Where does the business come from? Does it make sense strategically? Or do they want to get just rid of some business which they have to take and not really happy with? These are the questions you have to ask yourself, and you should feel comfortable with the underwriting or with the credit analysis capacity of a financial institution, of a bank, and then you should have a good common sense of the selection behavior. Of course, you can argue what is selection, what is good, what is bad. Everybody has a different opinion on that. So I wouldn't use the word anti-selection, which is so negative. But of course, it's a point of attention. And if you watch out for that and you make the bank a bank working for you, then I think it can be a terribly attractive field to discover for the insurance market going forward. And the products which you were mentioning, we're very cautious on that. With very, very small amounts, which we look into it. We want to learn, we want to understand, and this is not from scratch that we read a book about it and then we go for it. We want to understand in the detail. And that's what I said in the beginning also, the devil is in the detail. You have to understand yourself. Can I make myself comfortable, or am I so far away from a zone of comfort that I will not understand it? These are the questions which you have to ask. And if you have a good answer to them, I see a lot of growth opportunity.
Excellent. Thanks, Paul. And I think the phrase understanding the risk, not just the risk itself, but the structure and all the, I guess, the additional information and supplementary information that kind of make that transaction what it is so crucial when you're starting to step into new asset classes.
Absolutely. That's absolutely key.
Yeah. I'm really conscious there's so many questions that I have here to kind of come. So I'm going to keep fire away, and we'll try and make the answers a little bit shorter so we can get everything in. One of the areas that we've often seen, which was really pre-COVID, that paused slightly, was what we call, or I call, kind of the convergence trend. Some of the things that were principles of underwriting that we see in the structured trade credit world, we're starting to see in the trade credit multi-debtor market in terms of, especially around syndication. And I know a number of insurers are there saying, well, actually, syndication is the way forward, especially when you have big concentration risks. So do you think that is likely to continue, or do you think we'll see some resistance from certain carriers within our market to continue down that path? And maybe a hand up if anyone wants to take that question. Well, Mike, your hand went up first. Is that the real hand, not the electronic one? So, Mike, over to you.
Yeah, I didn't find my electronic hand on this system yet. So I think it's a really positive thing, this convergence, and it's been quite a long journey. I mean, Pradius, Euler, and Coface, sorry, I should say Allianz, shouldn't I? I apologize. Each set up a kind of structured credit unit some time ago now. And that history is getting on for 20 years or so. And I think it's really encouraging that the big three have embraced this type of underwriting and syndication through those units, and that knowledge is gradually filtering out within those organizations. But I see it as a continuing trend. At the end of the day, what is in the best interest of the customer? And if you think about at the moment, when credit limits are under pressure because of inflation, you can see that clearly the best interest of the customer is for the market to work together to stretch to those limits and give them the cover they need, rather than each underwriter being precious and saying, no, this is my territory.
Yeah.
So I think it will continue, and it's a good thing.
Excellent. Harpreet, I see you nodding as well. I think the US market's probably more familiar with that concept from a trade credit perspective anyway. I don't know whether you want to add to kind of Mike's comments.
Yeah, it definitely is. And I think I agree with Mike 100%. I think it's positive. I particularly think the syndication is positive for the industry. I think when we started out, we talked about a couple of carriers exiting. That may be also a reason why we're seeing more syndication, so that policyholders aren't left without a carrier who they may have worked with for years. So syndication helps to offset that risk.
Excellent. Thank you. And I'm going to maybe be a bit cheeky and put a question in here that we probably didn't discuss when we had our kind of get together before. And I think it's important that we raise it, because I think it is top of mind with most firms that I certainly speak to, and that's the ESG agenda. I mean, you hear of things that we're doing in our industry. Are we moving quick enough? And what do you think, what is it that we will do? Is it about client selection, or is it about helping each client on a kind of ESG journey? I don't know, again, hands up if you'd like to kind of take that one. Harpreet, thank you.
Yeah. Well, it's an interesting topic, because I think the last thing we want to do as an industry is put forth, this is what ESG is for us, and not follow through on it. So I think it's, with respect to ESG, you can put it into your underwriting. We're seeing S&P having an ESG analysis now on the credit reports that we look at. So I think it can go into your credit. I think it can go into the quality of the policyholders, particularly the banks. The banks have a lot of focus around ESG, and I think there's an opportunity here for our industry to support the banks, because we ultimately, as an industry, are aligned with the with some of the objectives, especially around climate change. So I think there's an incredible opportunity to partner with the banks. I think you can also say ESG along product lines, industry. So there's a lot of ways to measure ESG that we don't have to say this is the only way. And I think there's like I said, there's an incredible opportunity.
Totally agree. And again, just in my anecdotal kind of experiences already, that our clients they're saying, well, the market, the insurers provide us with access to insights around creditworthiness. How do we also understand the kind of ESG ratings of our customers? Is that something that, where do we get that expertise from? And I think there's a natural extension of what we do within our market. So Mike, over to you. If you could keep it really quick, because I'm going to jump in and maybe one last question we can squeeze in before I pass back to Richard.
So I just wanted to recommend to everybody this book, which I'm reading on my travels this week. It's about Greensill, and recommend it to everybody in our community. But you in terms of ESG, there's food for thought for us to have there. But yes, of course, ESG applies to us as well.
Thanks, Mike. Really quickly, I think it's another topic slightly off-piste in terms of, but I think it's really important, and that's around the kind of talent war. And also, so I'm going to come to you because, I think it's really important that we make our industry as attractive and a place where, young talent wants to come and work and learn. And just speaking to you, I've learned a lot, even at my stage of my career. So what do we do? What can we do better to attract the business? And maybe Arthur, then I'll come to Paul quickly.
All right.
Just a very short. Sorry, Arthur. Sorry.
Yeah. No, go ahead, please, Paul.
No, just a very short remark to our new colleagues. I said to all of them, it's so rich what we are doing. The changes are so rich. There's so many things going on. You don't have to change jobs. The change will come to you. So every 2.5 years, you get automatically a new job. And I think this is amazing already in our niche. And if you look at the industry as a whole, which is by far larger, it's tremendously attractive. The delta is, or the challenge is, that a lot of companies are very small. So in a hierarchical sense, the development is limited, and there we should also be fair. But what is really good is it's so rich. It's so much which happens in change, and this is something we should communicate.
Brilliant. Thanks, Paul. Arthur, over to you for final words.
Yeah, to be honest, I think Paul very well almost summarized what I want to say, because the good change is already happening. I mean, we see it on the example of Bern Union's Young Professionals Initiative, where we attracted the sort of a new rising talent from our membership and assigned them to certain tasks to develop our community, and the quality of outputs, engagement, exchange, the form of exchange, even before the pandemic, when Zoom calls and team calls was kind of was not your primarily tool of choice. All of these approaches, it's kind of a good indication that a lot of very good qualities coming in. It comes in, I have to say, also with a bit of a different perspective. So it's sort of a bit of a different way of thinking about, for example, transparency, diversity, inclusion, equity, and what we see that many of this young talent which is coming into our industry is more oriented on expecting more horizontal or flat hierarchies as opposed to more for vertical or traditional way of collaboration. So in overall, I think good things are happening, and I think Paul said it best. Thanks.
Excellent. I've just realised we have got 2 minutes left, and there has been one question that's come in from my dear friend Erin Charrett, who great guy. So, do you believe the credit insurance market will see disruptors step into the market and shake things up completely, or are we more likely to see tech companies partner with existing insurers? So, I guess that's back to that tech question, of whether we think that's going to be tech working with existing insurers, or whether we think there'll be disruptors disrupting the kind of the carriers that we have today.
If I might continue, just a couple of points. I already referred to this digitalization exchange, and one thing we noticed from this exchange of experiences and latest practices is that there's a pattern of collaboration between young uprising startups and the traditional players in the market. So this is not the area where, as one would expect, someone new comes in, breaks and shakes things and completely turns around. So I presume this trend will continue in the same pattern of traditionals more actively cooperating with maybe much more flexible and swifter starting up players who can come in with the technology.
Excellent. So I think, sadly, that is all we have time for. We are literally on the hour. So thank you all panelists for your fantastic insights, your sharing your experiences and views. I mean, I think we have a great future. If you think about the kind of uncertain world that firms and financial institutions operate within, being able to work with a product that is there about enabling trade around the world, I think that is a privilege in itself. So thank you again for your participation, and thank you to the audience for listening for this hour. Hopefully it's been worthwhile, and I'll pass back to Richard.
Thank you.
Richard, you're mute.
Richard, unmute.
Richard is on mute. Is Richard understandable now?
Yes. Over to you, Richard.
I started to say I can only echo what Nicola put on the chat, and that was thank you. Very interesting discussion. And what I was grinning to myself about, if that broker 10 years ago would have heard this discussion, he probably would have not said the same thing as he said 10 years ago about the dull, lazy. Have an ECA at the table through the Bern Union, a brand new MGA, a loss adjuster come IT expert, come industry expert, and an insurer linked to a bank, and to throw in for good measure, a broker at an ICISA event. Now, this is new, and this adds to the diversity of the market, diversity in brains, diversity in capital. And that can only be of interest to the ultimate client who we all serve, whether corporate or financial institution. Now, we will hope that this panel will serve as food for thought with an ongoing trend of innovation in product and product delivery. That was great, guys. Thank you very much. And it doesn't stop here. So in 4 hours, we will reconvene to examine the developments in the US market, which Harpreet alluded to just a second ago, with a panel of top experts. So join us 11 a.m. in LA, 2 p.m. Eastern Time, 7 p.m. in Sao Paulo, 7 p.m. British Standard Time, 8 p.m. CET, and for good measure, 4 a.m. in Melbourne. Tomorrow, for those fancying a little bit of sleep, we will be starting at 10 CET again with an item which has been touched on today again, and that is attracting and retaining talent to our industry, something that we need very, very badly. With that, I thank you all, and I hope to see you again in a couple of hours. Thank you.
Thanks, Richard. Thanks, panel.
Richard.
Thank you. Bye-bye.
Thank you.